All right, ladies and gentlemen, we're going to get into what we do every year, our outlook on insurance. So this is 2026 Insurance Market Outlook. We're going to go over good, bad, the ugly, what's going to be coming down the runway. We're going to also have this in long form. We're also going to have our marketing team break it up per section. The sections that we're going to go over in this particular outlook are going to be why insurance rates are exploding, the loss ratios, reinsurance spikes, contractor inflation, and the catastrophic events. Obviously, if you live in the United States, there's no shortage of spectacular weather. Section 2, extreme weather is not going away. We're going to talk about the billion-dollar storms, wildfires, climate impacts, what's driving national losses. Section 3, we're going to go over the current homeowners insurance crunch, rising premiums, shrinking availability, carriers exiting major states. Section 4, we're going to go over cosmetic roof damage exclusions, carriers pulling back on paying for cosmetic hail and wind damage and what that entails. Section 5, the rise of deductibles, how to protect yourself. 1%, 2% wind and hail deductibles becoming the standard across the United States, how to mitigate those costs. Section 6, we're going to go over luxury versus non-luxury auto trends, luxury insurance surging, non-luxury or trend shifting, uninsured rates still high. We're going to go over Section 7, thermonuclear lawsuit verdicts, massive jury awards reshaping liability insurance and business exposures. Section 8, why the insurance talent shortage should matter to you and what's going on in our industry, half the workforce retiring, shrinking expertise, and why independent brokers matter more than ever. So we're going to start off with why insurance rates are exploding. Insurance rates are not exploding because carriers simply want to charge more. They're exploding because the math has broken down. For the last several years, insurance companies have been operating at over 100% loss ratio. That means that for every dollar they collect in premium, they are now paying out more dollars in claims and expenses. So similar to Missouri where we're at, even though we're a nationwide agency, average home insurance carrier loss ratio, 198%, which means they're giving out $2 for every dollar they're taking in. In 2024 alone, U.S. insured catastrophic losses hit approximately $112.7 billion. That was about a 36% increase from the prior year. Globally insured catastrophic losses reached roughly $137 billion. This continues as a decade-long trend of elevated rising catastrophe activity. And it's not just the headline-grabbing hurricanes and wildfires. In 2024, the U.S. experienced 27 separate weather events that each caused more than $1 billion in damage. Today, an estimated 64% of all homeowners insurance loss dollars come from catastrophic weather events alone. That is the single biggest factor pushing loss ratios above 100%. On top of that, we have contractor-driven claim inflation. Not every contractor is a problem, but enough are. Inflated repair bills, unnecessary roof replacements, and so-called storm chaser companies coaching homeowners into exaggerated claims that are adding billions of dollars in avoidable cost to the insurance system. Those costs do not disappear. They get banked into the rates that everyone's paying, including homeowners who never filed a claim. Then there is reinsurance, the insurance that insurance companies themselves buy to protect their balance sheets. In 2023, U.S. property catastrophe reinsurance rates jumped 35%. That was the largest increase in roughly 17 years. Then in early 2024, those rates climbed again by another 5.4% or so, pushing reinsurance costs to an all-time high. And again, the carriers are going to pass that buck down to the homeowners. When reinsurers dramatically increase what they charge carriers only have a few choices. They can raise rates, reduce coverage, or shrink their footprint in certain areas. In reality, most are doing some combination of all three. So when people ask, why are my insurance rates exploding? This is the answer. Record catastrophic losses, runway claim inflation, reinsurance rate spikes, lawyers and contractors, and multiple years of 100% plus loss ratios. This is the math behind the 2026 insurance landscape. That is why rates are rising for homeowners, drivers, business owners across the country. Right now, we're going to jump into Section 2 of this. Extreme weather is not going away. If you want to understand the most devastating reason why insurance is under so much strain, you have to look at the weather. It's not just the first half of 2025. The United States experienced 14 separate billion-dollar weather and climate disasters. Together, those events caused an estimated $101.4 billion in damage. The single most devastating event was the January Los Angeles wildfires. Those fires caused approximately $61.2 billion in damage. That makes them the costliest wildfires in U.S. history, nearly doubling the previous record. Those were not the only issues the first half of the year. Also included multiple tornado outbreaks, such as the 600 across the Midwest, destructive hailstorms, and other severe storm systems sweeping across the central, southern, and eastern United States, each of those contributing billions of dollars in additional losses. To put this in perspective, over the last 46 years, the U.S. has averaged about $9 billion events per year after adjusting for inflation. 2025 is already well above the historic average. Since 1980, in the United States has recorded 417 separate billion-dollar disasters. The total cost of those events now exceed $3.1 trillion. The data set that tracked these events was once managed by the National Oceanic and Atmospheric Administration, otherwise known as NOAA. It is now maintained by Climate Central and scientist Adam Smith, and he continues to show the escalating economic toll of extreme weather. The forecast for 2026 is simple. The weather's not calming down historically, and the financial impact on insurers, reinsurers, and policyholders is only growing. Now we're going to jump into section 3, the current homeowners insurance crunch. So homeowners insurance is becoming more expensive, harder to get, and in some regions nearly impossible to secure from major national carriers. Right now, about 88% of the U.S. homeowners have some form of homeowners coverage. The average annual premium nationwide is now over $2,800 annually for a home that has a replacement cost of $300,000. 21 states have average premiums above $2,000 per year. At the top of the list are Nebraska and Oklahoma, where average premiums are close to $8,000 per year. A lot of that's going to be leading to your tornado devastation in those states. In certain cities, it can be even worse. Oklahoma City and New Orleans stand out with some of the highest homeowners insurance average in the country. Let's not also forget Texas and Florida that are consistently raising year over year. We're also seeing key market exits. Major insurance have stopped writing new homeowners policies, or they significantly pulled back in states like Texas, Florida, California, and Louisiana. In Florida, the driver is hurricane and wind risk. In California, it's wildfire risk. In Louisiana, it's flooding and severe storm risk. In a recent extreme case, California regulators approved emergency rate hikes for State Farm, up to 38% on certain lines. The forecast looking into 2025 and 2026 is clear. Premiums are expected to continue to rise, and in some regions, market access will likely tighten even further. For homeowners, that means higher cost, fewer choices, and more pressure to understand exactly what is and what is not covered. The biggest thing leading this, you guys, too, in the Midwest is going to be your tornadoes, your wind, and your hail. The reason why states have to improve these rate hikes is if the carrier can prove their losses, meaning that they're not making any money in that state, if the state doesn't want to approve the rate hike, then the carrier just pulls out, which means you have less options. So it's not done just to make money, as most people assume. Section 4, cosmetic damage exclusions, which is a big one that's starting to come out in 2025 and will be exceeding into 2026. Let's start with something many homeowners are only finding out the hard way. Many carriers are no longer covering so-called cosmetic damage on home insurance claims. That includes things like hail dents on metal roofs, gutters, downspouts, and siding. If the damage does not affect the structural integrity of the home or the roof and the system, and if the system still keeps water out, many policies now exclude it or drastically limit how it's paid. From the carrier's perspective, this is a cost control move in response to rising loss ratios and weather severity. From the homeowner's perspective, it's a surprise gap in coverage they thought they had. The big takeaway for 2026, cosmetic damage exclusions are here, they're growing, and you must know whether your policy will pay for these types of claims before the next storm hits. Another side of this is going to be like siding. So if your house only gets hit on one side and they can't match that siding, a lot of carriers now are not going to replace the other three sides. I understand that upsets people, but it just adds to the growing amount of payout by homeowners insurance companies, which leads to the collective rate, which we're all paying. That's why this is going to be seen in a much bigger way going into 2026. Section 5. the rise of deductibles and how to protect yourself. There's another major shift happening in insurance that most people don't see coming. Deductibles, they are rising. They're rising fast across the entire United States. For years, most homeowners had simple flat deductibles, $1,000, maybe $2,000, but now more and more insurance companies are moving to percentage-based deductibles, specifically for wind and hail, the most common and most expensive claims in the country. What a 1% or 2% deductible really means, a 1 or 2% deductible doesn't sound bad until you do the math. If your home is insured for $400,000, a 1% wind and hail is $4,000, a 2% is $8,000. What you need to recognize, folks, is when they say it's a percentage deductible, it's the percentage of what the home is covered for. And in many states with severe weather, carriers are pushing even higher. This means homeowners who used to pay a $1,000 deductible are suddenly responsible for $5,000, $7,000, sometimes $10,000 or more before insurance pays a single dollar. This is one of the biggest financial shocks hitting homeowners today. Why carriers are doing this is carriers aren't increasing deductibles for fun. They're doing it because of weather claims become massive and unpredictable. Higher deductibles allow for carriers to shift more of the cost back to homeowners, reduce the number of claims they pay, offset rising repair costs, and protect themselves from severe weather losses. But for everyday people, this means far more out-of-pocket risk. But this is happening everywhere. In Missouri, where we're at, for example, we haven't had percentage deductibles since 2012. They're now back in a large way. They're at 1%. They were targeted to go to 2%. That since pushed back, but in states like Texas, 2% is the lowest you can get. Why programs like Deductible Defender matter, here's the good news: you can protect yourself from these rising deductibles. Programs like that we offer here, like Deductible Defender, are deductible reimbursement programs, and they're becoming a central tool for homeowners. They help cover the cost of your deductible when something happens, so you aren't stuck with a sudden $5,000 or $10,000 bill during a crisis. These programs can reimburse your deductible after a claim on both home and auto. They reduce your out-of-pocket burden, protect your savings during severe weather, make high deductibles actually manageable with deductibles rising. These programs aren't just add-ons, these are safety nets. This is important for you guys to understand that and to look up our Deductible Defender program if you're interested to kind of offset that cost. The other thing to mention, similarly with carriers like Travelers, they did a minimal last year of a $5,000 deductible. Now they're going to 1%. So if your replacement cost is below $500,000, under $500,000, when you get your renewal, you might want to opt now to go to a 1%, which will actually be lower than their $5,000 minimal. That's something to be looking out for in 2026. Section 6, luxury versus non-luxury auto trends and the new divide. Now let's shift gears to the auto market, where the gap between luxury and non-luxury vehicles is getting wider. Since 2026, luxury car insurance shopping is up 116%. So are the repossessions. We don't have those stats in here, but they're probably higher than the luxury car shopping. And the same period, non-luxury car insurance shopping is actually down 5%. So luxury car insurance rates have climbed 56% in the last 5 years. Non-luxury car insurance rates are up 41% over that same period. The top 10% of U.S. earners, those with incomes between $200,000 and $1 million, are driving most of the growth in the overall insurance spending. Drivers of popular non-luxury vehicles shop for insurance about 11% less often than those high-earning luxury drivers. Meanwhile, on an even more grim note, roughly 15% of drivers in the United States remain uninsured. That's 1 in 7 people on the road. Hence why we really study uninsured and underinsured motorists on your policies. The average annual cost for full coverage auto insurance in the U.S. today is generally between $2,400 and $2,900 respectively. Heading into 2026, expect to see continued pressure on luxury auto rates, more sophisticated pricing for high-value vehicles, and ongoing challenges around uninsured and underinsured motorists. The other thing to mention too, auto insurance is increasing across the board due to the average car on the road now being almost $60,000 and the average used car being almost $30,000. Accidents are more expensive than ever. Now new cars need windshield calibration, headlight calibration, which is now a third party adding to the rise of claims. Section 7, thermonuclear verdicts. So this is a big one. Across the United States, liability insurers are being squeezed by soaring jury awards, now known as nuclear verdicts. A nuclear verdict is typically defined as a jury award exceeding $10 million. In 2023, there were 89 such verdicts, with total awards reaching $14.5 billion. That is a 15-year high. Even more alarming are the so-called thermonuclear verdicts where awards can top $100 million or more. These are becoming more common as well. In one high-profile case in 2024, a St. Louis jury awarded $462 million in a trucking liability lawsuit. That amount was later reduced to $120 million, but it still illustrates the extreme scale of today's awards. Driving these verdicts are social inflation, changing public attitudes towards large corporations, and the growth of third-party litigation funding that helps fuel along aggressive lawsuits. For insurers, this means higher claim severity, more volatility in their books of business, and intense pressure on pricing and capacity. As a result, carriers are raising rates, tightening coverage terms, adding exclusions, and lowering the limits they were willing to put on the line. This is really seen in the business liquor liability situation here in St. Louis and Illinois as well. Due to high verdicts, very hard to get that coverage and rising rates. Ultimately, these costs are passed on to consumers and businesses through higher premiums, in some cases higher prices for goods and services. The other big thing that you're seeing too is umbrellas. So personal insurance umbrellas, commercial umbrellas, they're through the roof. Why? Claims are up 43%, and that is mainly due to your personal injury attorneys getting incredible lawsuits across the line, which is leading to an insane amount of volatility in insurance. Section 8, why the insurance talent shortage gap should matter to you. There's something happening behind the scenes in the insurance scene that most people don't know about, but it affects every homeowner, every driver, every business owner. Half of the people who actually know insurance, how it works, are about to retire. The average insurance professional is 63. And almost no young people are entering this field. That means the people who know how to solve problems, the people who know the carriers, and the people who know how claims actually get paid are leaving. And there's not enough trained people to replace them. Why this matters to you, insurance isn't like shopping for a TV. You can't just compare prices and click buy, even though some people do regrettably on most platforms. When something goes wrong, you need someone who actually understands what they're doing. But as experts retire, here's what's happening. Fewer people know how to fix complicated problems. Claims can take longer with little to no involvement from your agent or broker. Mistakes cost more, not only on the way the insurance was designed, the way the policy performs, and the way the client gets educated to understand it. And people get stuck with bad coverages because no one explained the fine print. This is the reality most customers never see. The other one I want to explain is captive agents versus independent brokers. The gap is getting bigger, right? There are two types of insurance agents, and these get confused. Captive agents, they only typically offer one insurance company. Whatever the company charges, whatever the rules they have, whatever decisions they make, the agent is stuck with it, and so are you. As a captive agent works for the company, not the client. Independent brokers, such as us, they can shop around with multiple companies. They can compare coverages through multiple carriers. They can move you if rates spike. They can negotiate when things don't make sense, when they can actually advocate for you because they work for you, not representing the carrier. In a world where expertise is disappearing, having choices matters more than ever, because if one company pulls out of your area or raises rates 40% or they deny a claim, a captive agent can't help you. An independent broker can. Why knowledge is everything. The truth is insurance looks simple on the surface until you have a claim. That's why we often say if you only shop on price, eventually you'll pay the price. Then when it comes to the most complicated thing in your life and the most moments, you need someone who knows which companies actually pay claims. You need somebody who understands policies and hidden gaps, how to push back when you're getting the runaround from the carrier, how to protect you from paying for something your insurance should cover. This kind of knowledge isn't taught in a classroom. It comes from real experience of people being in the trade for an extended period of time. That's why having a strong independent broker with experience matters so much right now with the rising of claims and insurance getting more expensive. It's getting more complicated. It's getting harder. Experts are retiring and the system is getting more confusing every year. You deserve someone who will fight for you, someone who understands the fine print, someone who knows how to get things done, someone who will go to bat and advocate for you when it matters. That's what independent broker does. So ladies and gents, that is a wrap up on the 2026 outlook. If you're a client already and you got our Christmas card, it led to the volatility of 2025. That's not to say we're not optimistic about things shaking loose and bringing on more carriers and different platforms to offer to you. But the reality of it is what we do here is not cut and dry. It's not copy and paste. And I think more people are getting more impressed and wanting to be more educated and have an advocate behind the scenes, because it's not only what you're paying for, it's how we're performing year over year. And it's when it stands up when it really matters. Not all carriers carriers are created equal, neither are agents and brokers. It's important for you to get someone you know and trust and someone who has the experience to back that up. This is our 2026 Insurance Outlook.